Hello, everybody. It's Jake Gino, host Jake Gino Podcast here with my co-host, the multifamily mentor, the coach, the chef, the father, the best-selling author, the G-Daddy, Gino Barber. Gino, how's it going?
Jake, I'm doing great, brother. How you doing?
Always making it happen, big man. Today's guest has a real estate career that spans over 4 decades. Gino, I think that's 40 years. It's a long time. Currently serves as CEO of Quinn Residences, a real estate operating company where he continues to use his expertise to create inclusive communities that enhance resident lives. Sounds like the Chick-fil-A of build to rent, build for rent. Which is it? I don't know. So without further ado, Richard Ross, the boss. Welcome to the show.
Thanks, guys. Thanks, Jake. Thanks, Gino. Glad to be here. Thanks for having me.
Hey, it's our pleasure. So before we got on, we did a podcast, and Gino was trying to ask all these questions, and I want to hear the real story. So 5 years ago, you got into build for rent. Tell us a little bit about your real estate career before that, and then that transition, please.
Sure. So I've been in this business 40 years. First 10 as sort of a financial guy, and then got into real estate in the early 90s when all of the big real estate companies you know today, the big public companies that own half the apartments in this country, were formed. And so my background is both public and private real estate operating companies, from multifamily apartments, if you will, and then grocery anchored shopping centers. And I've been involved, as I said, both at the public and private level. The build to rent thing started almost 5 years ago when a guy I had run a company for approached me and said, "Hey, I've got this business plan. It's called Build to Rent. I need somebody I know and trust to run it for me and build it up." And I said, I'm 60 years old. I'm kind of thinking about retirement, but send me the plan. Let me take a look. And the plan was compelling. All the things we're going to talk about, I'm sure, in the next few minutes here, supported this business plan. Shortage of supply, demand from millennials. This is all pre-COVID, right? Pre-pandemic. And it was a very compelling business plan. So I said, I'm in.
What made it compelling?
All the things that I saw in the early 90s in the multifamily business, meaning a shortage of supply of homes, an aging demographic, right? Back then it was people coming out of college and, the young millennials.
You're getting the newbies and the oldies there all in one, right?
Exactly. And so the aging millennials, people wanting to get out of a 2-bedroom apartment into a 3 or 4 bedroom home, which is what we deal with exclusively.
That they don't have to take care of.
Right. Don't have to take care of, the maintenance-free lifestyle. And so all of that was very compelling. And it was also an opportunity, frankly, to build something literally, pun intended, from the ground up. Not a lot of people were doing this exclusively, right? Purpose-built communities for rent. A lot of people, a lot of companies, big companies today, public companies have done what we call the scattered site business, meaning buying homes off the MLS, buying homes from realtors, buying the last 20 homes in a subdivision from a builder and renting those out. This was a more purposeful business plan, meaning we are going to build an entire community separately amenitized, meaning its own amenities for rent, where every home is for rent. And that was the gestation of the business.
Richard, what was the risk in the business plan?
So the risk is, obviously, you're going to build these homes. You're going to build a 200 home community, and you can't rent it. Or you can't
rent it for enough, right?
You can't rent it exactly for enough. Obviously, I have investors. They need to make a return on their investment. And that was the risk. Although I will say, guys, the downside of that risk was if it didn't work, you just sold the homes at retail, as we call it. So that was sort of the downside.
What's the worst thing that could happen? You sell the home.
The worst that can happen is you don't.
I'm sorry. That was. Yeah, I always ask myself that question. What's the worst? Yeah. And I answered it. So sorry for you being.
No, but you're right, Jake. That was the downside, and I think that was the attraction to investors to put up money for this sort of new idea in real estate. I mean, real estate's pretty arcane, stodgy old business, and to have a new industry growing up, really in the last 10 years, but certainly didn't get legs until the last 5. And so, look, when we started, as I said, pre-pandemic, that was the business plan. Then the pandemic comes in, and you basically pour gasoline on the business.
That's sped it up.
Jake, I'm going to push back on both of you because you guys are both coming at it from being experts. I see the risk as you getting into this project and all of a sudden you don't move quick enough. And all of a sudden labor and material and supplies exponentially get a lot more expensive. And you're like, oh crap. And, people forget about what happened in the other recessions when building just stops, slows down, cost of capital gets a lot higher. You're not looking at a lot of these other variables that I said I had my Will Ferrell moment 10 years ago when somebody brought me this business plan. I'm like, that's the stupidest idea I've ever heard of. And I see all these other risks when you guys are just saying, hey, we just sell the homes. Now, Richard, you've been doing this for decades. This is not for the faint of heart. This is not for somebody who just started 2 years ago and doesn't have any type of team built out. You've got infrastructure. You've got experience. You've got cojones. You've got a lot of stuff to make this work. This is not something that's very simple to pull out and go, I'm going to buy this land at $10,000 a lot. I'm going to put all this infrastructure in. I'm going to build these homes. I'm going to have to lease this whole thing up. This is like a 3 to 4 year project. Am I wrong in saying that, or am I overstating?
No, you're absolutely right, Gino. To your point, it takes from a shovel in the ground, right, raw land, to a stabilized community, meaning your occupancy is now at 90%, so you've leased 90% of the home. It takes about 3 years. Mm-hmm. And as you point out, during the pandemic, we did have incredible costs over, right? You couldn't get garage doors. You couldn't get windows. Labor went way up. So we had to have the cojones, as you say, but also the capital to withstand those huge spikes. Construction costs have now leveled off. Supply chain has worked its way out. But obviously now we're facing really high interest rates compared to when we started, when money was essentially free. So there are challenges, there are risks, and we just have to weigh those. And being a well-capitalized long-term owner, we're not in this to build a community, lease it up, and then flip it. We're in this for the next 10, 20, 30 years as a ongoing enterprise.
Man, Jake, I've got some other questions. You mind if I keep jumping in here? Because
sure,
as Rich is talking about this, why are there developers out there that do all of this work and then after 3 years they've done it, they've got this goose that's laying these eggs and they decide to flip out? Because I know the vast majority of them do that, whereas you're holding these assets.
Yeah, I think the mentality has been, and look, we can go back during COVID or even pre-COVID. You build one of these communities, you're in it at a good cost, right? You bought the land cheap. Land is not cheap anymore, but back then you could get land cheap, as you mentioned. You build this community, you lease it up, and I won't get into a ton of math, but if you can make a 25% profit, which a lot of these guys were doing during sort of 22,
because they bought the land cheap, right?
Right.
Yeah.
They bought the land cheap. They built the home at a reasonable price. They leased it up at rents that are pretty competitive, particularly during those days. And, they could make a 25% profit. They'll get out, keep the machine going, right? A lot of these developers, their machine is build, sell.
And they don't have a management machine, so it may not be sustainable so I think that's where some of the issue comes in as well, right?
Right. And managing these things is not the same as building them, right? It's a completely different business. You're trying to keep your resident happy. Right? If I don't get a rent check from my resident every month, there is no business. So keeping that resident experience, keeping that resident happy, keeps them writing checks. That's a completely different business than just building the home at a reasonable cost and selling it. So that's been the history of this business in its early stages. Now, that's changed. You can't build and sell at that kind of profit anymore. So that has put sort of the kibosh, if you will.
What else has changed, though? Is it because of just the land cost? Is that what's killing it?
Land costs is much higher, considerably higher, particularly in our markets, which is the southeastern U.S. Land's just scarce. Home builders, retail sales guys who are building homes and selling them at retail, if you will, are paying more and more for lots. Mm-hmm. Because there's still a huge shortage of housing in this country. So that's one thing. And then managing these assets, these homes, is not easy. It's not for the faint of heart, right? It's a completely different business, as I said.
But
so
Richard,
that has sort of put the kibosh on a lot of these build flip.
I just have to. You've been in the business for so long, and you've seen builders come in, make a ton of money, then lose it, make a ton of money, and then lose it.
Sounds like Mike Tyson.
At some point,
he made a ton of money and lost, but he didn't lose the money. So.
Well, he's up there. But at some point, don't they say to themselves, I've got cost segregation here. I've got a lot of tax benefits here. I've got an asset that I've got a good cost basis in. Let me go find a Jake and Gino or a Richard to partner up to manage these assets. I don't want to manage. Let me partner up with somebody and I can go find another one and build another one, do what I'm really good at, but give away a piece of that pie. Are they starting to do that now, or was it not even a thought in their mind? Because if I'm going to spend the next 36 months of my life building these homes and doing all that work and making 25% and then praying that interest rates and the economy doesn't go sideways and hoping I can do it again, there's a lot of risk in that for me. There's a lot of work and a lot of heartache if that doesn't go well.
Yeah, you're absolutely right. And to your point, when we started in this business, we didn't have enough homes, enough scale. So we engaged what we call third-party managers. We had other companies managing these homes for us. I will tell you, in my 4 decades, as you like to chide me about,
it was in the show notes. Don't blame us.
It's okay. It's okay. I'm used to it. I've learned that no one manages an asset better than the owner, right? Because it's my asset. I want to make sure it's taken care of. And I'm a long-term holder, so I'm going to make sure I repair that home, I keep it maintained so that 30 years from now, it's in good shape. And so eventually we internalized our management. And so I think if you're a developer or an owner, and even if it's one community, or look, there's smaller owners that own 50 homes in a community, and this business is viable there as well.
Beautiful.
There are third parties that can manage these things well. Obviously, you have to supervise, right, whoever's running that operation for you. But it is an opportunity even for the sort of smaller investor.
Richard, I'm down in the Southeast. We're in the Southeast as well. Can you give me some metrics as to what you're trying to build, the maximum? Is it 3-bedroom, 2.5 bath? Are they townhomes? Do they have garages? Do they have amenities such as pools? Is it a high-speed internet? Is it electric chargers? What are you looking for? What does the actual resident base want right now?
So all of the above. We deal only in 3 and 4 bedroom homes. We're at 5,200 homes across 35 communities today. Half of those are townhomes, and half of them are what we call detached. Typically, every home has a garage and a fenced backyard. That's what residents
Talk
want.
about the fence. A lot of pet owners, they just want
it. We have more residents with pets than children.
Yeah.
Our average resident age is somewhere between 33 and 34 years old.
Are these chain link or vinyl, just so we can create the image?
These are actually powder-coated steel. Again, maintenance free, right? Wood fences you got to stain, and it's harder to maintain. This is just a little anecdote. We also put the gates on the side of the home.
For the little lawnmowers?
Right, because that's the other thing residents want. They want a maintenance-free lifestyle. They don't want to mow the lawn. They don't want to have to unstop the toilet. They just go on their little app, call us, and we're there to fix the toilet. The other thing I will say is flexibility, meaning if I want to live in Jacksonville for 3 years, because I have a good job there, but then, I might need to move to Denver, or I might need to go to Dallas for a job, for a life change, marriage, divorce, child, whatever. I can, at the end of my lease, I can move. If I own that home, it's a little bit more problematic.
Sorry, I'm geeking out on the fence. We got to stay there for a minute.
Okay.
Because we're into management and stuff like that. So talk about the evolution of the fence. Was it you gave one out and you saw premium, or it just became something that people love so much? Like, talk about, because maybe you started out with all these fences, but I have a feeling that it evolved. So
no, we piloted a community, I'll say, right? Yeah. We started with smaller communities. Our first,
give me an idea of how many. The
first 10 deals were probably 100 or less homes. Now our sweet spot's 200, just because of economies of scale, right? But with the fencing, we piloted it at a community, and yes, we learned that people will pay more rent, whether it's $25, $50 on average. It's probably $100 a month more, so they can let the dog out in the back or the
and it's just built into the rent. It's not like a fee added on, right?
No, yeah, it's built in, built into the base rent, if you will.
Yeah.
The other thing people really want is technology. So every home we build now has a smart home package, and that means, your typical, right, thermostat. We put a Ring camera on the front and back doors now, electronic locks, no keys needed. We put leak detectors in every home. We put a leak detector next to the washing machine, under the kitchen sink, and next to the water heater, so that the water heater gives out, as you know, that stuff happens. We get an email, and the resident gets an email as soon as it happens. So they're not coming home from work and their house is flooded. We put motion sensors in the houses when they're vacant. You guys are from Florida. You probably read over the last couple of years this whole trespasser. They call them squatters. We call them trespassers because they're breaking the law, where people get into your rental home and sort of hijack it. And so we put it when a home is vacant, we have a little disc in the home that tells us if there's movement in there, and that way we know that somebody's illegally.
And it zaps them too. It's a laser. It's the laser combo.
Well, that's coming soon. So those are the things, right? Technology, fence, backyard, garage is critical.
Love garages.
I tell people when we drive through our communities, when I drive through on a Saturday, and people are home, the garage door's open. They don't park cars in these garages. They're gyms.
They're man caves.
They're storage units. They're man caves or she sheds, or something. Playgrounds. They're not.
Or there's a '57 Chevy in there, and they work on it. I've seen that too.
100%. When that happens, they're not moving after a year.
Yeah,
we're actually
the garage is key to this strategy, I believe. Yeah,
very key. And we have some homes without garages, and they just don't get the rent that something does with a garage. The other thing I'll tell you we're exploring is 2 and 3 year leases with our residents, so that you can sign up and know you have this rent for the next 3 years.
Yeah, and you that reduction in turn costs is important, right?
So that you know this business, Jake.
Yeah.
You're speaking my language.
As long as it's not 2020 going into 2021, and all of a sudden you're underwater or something because the inflation. But I like it, right?
So what's critical to this business and keeping both turn costs and bad debt down is proper vetting of your resident, right? And we do
No, I'm just meaning if you have like an inflation run like we saw, and all of a sudden you were renting for, we'll just say 1,000, and now that becomes a break even, and you need to get 1,200 or whatever for the unit. That's the only risk there, right?
Correct.
See. Yeah.
Richard, can you talk a little bit about the demographics? Because I was looking at median incomes of people who rent these homes. I mean, they're 6-figure median incomes on average for a lot of these communities. Can you talk about the ages you're looking at and also the median incomes?
Yeah. So our average rent somewhere around $2,100 a month, and our average rent to income ratio is 5x. So that means these people are making 5 times their rent. In multifamily, typically a third is good, right? If your rent's a third of your cost, so we're way ahead of that curve. These people.
What about the cost to build though? So if you're 2,100, what's the average all in?
Well, I can't give you a total secret sauce here, Jake, but I will tell you our average home has gone up over the last 3 or 4 years for sure. Is probably in the neighborhood of $275,000 to $325,000.
And that gives enough of a spread where you guys are feeling good at $275,000 with a $2,100 rent.
Correct.
Yeah. And
it used to be $275,000. It's more in the low threes now. Having said that, we build these homes for long term. These are starter homes, right? 3 and 4 bedroom, granite countertops or solid surface countertops, could be quartz, stainless appliances, the tech package, all of that. But we build them to be durable. There's no carpet in our homes. We do not do carpet. We do solid surface flooring, even on the stairs.
Well, is that LVP or are you talking like tile? What do we?
It's LVP. In Florida, it might be tile, right?
Okay.
But it's typically LVP, and then they can put their throw rugs down or whatever.
Is there a quality risk there as well? Because that's the other thing when we were talking earlier. I'm saying, how big can you go in the home before there's a risk there, and you're not going to be able to get a large enough population that can afford that? And then is there a quality risk as well, which is essentially cost, right? Where you start to get to a point where it's like, this is getting uncomfortable from a spread perspective.
Yes, I mean when you talk about like the size of the home.
So it's all cost related, right? So like, what the average size of your home is 2,000 square feet, 1,800. What are we talking?
1,800.
1,800. But like, if you went to all of a sudden, just per se, if you went to 2,100, and then there's more tile, there's more granite. Are we talking brick exteriors? Like all of this starts to throw dollar signs off, and then you might get a little uncomfortable because the price of the home is now $350, but your rent is being capped at 21 or 22 or something. That's where I'm trying to get my head wrapped around.
Yeah, and I will tell you, anything over 2,000 is. We have 2,300 square foot homes. Mm-hmm. They're too big. They're too big.
Say that again. 2,300 is too big.
It's too big from a cost perspective
And a demand.
and you're right, and demand. Like people now want a little bit more compact, more usable space, more open space. In other words, that third bedroom.
And the affordability.
Right. I mean, we're today, I'm going to look at some stats here. Today, we're somewhere between 30 to 40% less to rent a home from us than to own the same exact home.
And that's a great competitive advantage.
Right. Huge.
And you got to keep that in mind when you're talking size and cost of fixtures and things, right? Yeah.
Right. And that's what's been driving this business for the last, 4 or 5 years. Historically, renting's been about 15%. I'm talking like the last 50 years. So there's a market today where renting is considerably cheaper. And I'm talking all the costs of rent. So that's the maintenance, that's the property taxes, that's the insurance, all the things that you face.
Yeah. It's a big deal. What was it like for the maintenance guys going into this tech package world? Because you got guys that are, okay, we can change, the water heater,
light bulbs,
et cetera.
AC filters.
Yeah, now all of a sudden you're giving them these ring things with logins. They must have wanted to kill you.
So, yeah, but it's just training, right? We spend a lot of time and money training these guys.
Don't just brush over this, all right? You take a 60-year-old guy that's been doing maintenance his whole life with water heaters, and you tell him you need to log in now. You're going to start troubleshooting the tech. It's just training. Like, come on, it's not that easy. We know this.
Well, it is. They all have iPads. They're used to using an iPad.
Dude, we got 80 guys on staff here, and I'm going to tell you right now, it's not going to be that way for all of them when we get to this point. We'll get there. We'll do training, but I'm just saying, it
is all about education and learning how to use the technology. The technology is provided by a third party, so it's a package, right? Comes in literally, the builder gets a box from this vendor, and they teach them how to install it throughout the house and then maintain it.
Yeah.
Right.
Hey, I can almost hook up a Ring camera, so I know it's reasonable, and there's a path forward.
Well, you got some headphones on.
You know what the greatest thing about these headphones is? So I have problems with them, like all this stuff all the time, like something's not working. And so now what I do is I test every connection before I get it, and then I hear the humming, and I know, okay, I'm good. Okay. Yeah. And I did that today. So, I'll put that into an SOP. I'll train everybody.
Guy, right?
No, your maintenance guy would have picked up on that a lot sooner. Okay.
Yeah,
so
maybe so. But Richard, it's a good point.
Let me ask you a couple of questions about the communities themselves. Have you ever bought a community where you have like 200 lots and you've sold some lots to limit your downside risk and get some capital back, or you don't do that?
Not as a matter of practice, but I will tell you during the early pandemic days when costs were going up like hourly, lumber was ridiculous and you couldn't get a garage door. And yet home builders were selling homes like crazy. They're selling homes very, very at a healthy pace today. But remember when interest rates were 3%, those guys couldn't build enough homes. So yes, there are one or two deals where I'm just going to make this up. We had 150 homes and the builder we contracted, you're going to build this home for $250,000. And now he's realizing, oh my gosh, I'm going to lose money because of the increase in cost. So we said, we're a good partner. We do a lot of deals. We work with a lot of builders. And we said, fine, we'll give you 50 lots back. You can sell them build your home on there, sell them at retail. And, that'll help you get some of your costs back.
Did you cut those out in a new survey for financing purposes?
Yes.
Let me, I had another question about the whole development. As far as going down there, how do we take care of this supply challenge that we have? I mean, how are you finding more land to build on right now? Because that seems like there's a risk. Everyone's talking about we got to get rents lower. The only way you get rents lower is by building more, by increasing supply. Are you having problems finding land at reasonable cost to build right now?
Yes. That is the single largest impediment to my business and even to the big home builders is finding available land to build that you can get at a cost that sort of makes sense.
What do you like from a per unit perspective on land cost?
I'd like to be in a lot for, it depends on the market, obviously. Florida's different than rural, than Charlotte, than Raleigh. But on average, let's say anywhere between $60,000 and $80,000 of what we call a finished lot. So a lot that's
finished lot.
Lot that's ready.
What about raw land?
We don't really deal in raw land.
Okay, you get the infrastructure and then you go.
Right. We only deal in entitled land. It's got to be entitled, zoned for what we want to do. Now, we have a very unique credit facility that allows us to buy the land, work with the developer, right, to once he's got it entitled, to do the horizontal, right, the site work, as we call it. So we can partner with builders and developers in helping them at the beginning of the cycle, so they don't have to risk their capital, right?
Word to mother. We were talking about materials. Have you since, we'll call it COVID, looked to more readily available, and maybe you always have, but I'm thinking readily available products that are typically on the shelf. So it's standard size windows, like 36-inch windows, et cetera, so that if things go sideways again, there's less risk, and the products that there are more readily available, you're going to have access to those.
Yes, without question.
Or have you always done it, or was it a transition? I guess.
No, that was a learning. We've learned a lot of lessons, right? In any new business, you learn what works and you learn what doesn't. That, and I will tell you, as I mentioned, we build a durable home. We mentioned the LVP.
Hardened asset, Gino.
We use really good paint. I won't mention the provider, but it's a really good quality paint, and we do 2 coats of paint on every wall, and the entire community is the same color inside, so that when we do have to turn a unit, you can.
What are we talking? Chantilly lace?
No, off eggshell white or some sort of.
Oh, dude, it's definitely not that. It's way more foo-foo of a name than that. Come on, dude.
Right,
we're talking to a builder, Gino. This is actually refreshing.
But unlike a builder's starter home where they just throw some cheap paint up there because they sell the home and they don't have to worry about it.
Yeah.
We consider, right, having to what we call, instead of painting corner to corner, when you turn a home, you can touch up because you've got 2 coats of really good paint, and the paint's consistent throughout the community. So those are the kinds of things we've done. As you said, standard windows, standard appliance package, all of that goes to
probably concrete out back, like you have a concrete pad or something for the deck.
Typically a concrete, but no slider doors anymore.
Yeah.
No sliding doors. A maintenance nightmare, security nightmare. We typically try for a fixed glass pane and then a sort of half a French door kind of thing.
Good pickup there. That's smart. Yeah. No, we essentially we're moving in the direction that you're at. We started with garden style apartments, and we've not exclusively gone to, but I would say the bulk of the newer stuff that we buy are townhomes. We bought a build for rent community actually earlier this year from a developer. And we like the 2 and 3 bedroom townhomes. Typically if they have a garage, it's a huge bonus, washer dryer hookups. But I think that the big takeaway for me today, Gino, is the fencing. It could be a good one for us, man. Longevity, baby.
For itself. And you mentioned, EV chargers, and we put solar on one community, was very successful. Mm-hmm. And we're now rolling it out on 4 others. There's some tax advantages to that. You guys probably can appreciate.
Well, and other things with the EV too, right? There's something going on there, maybe in different local communities.
Yeah. Well,
right?
what we learned with it, so we started putting these little EV pumps, I call them, in the.
I think you just need the connection, though, right?
But what we do now is every home is wired for an EV charger in the garage. It's behind the sheetrock. Yeah. And then if a resident has an electric vehicle, which, there's been some backlash, and maybe they're not going to sell as many electric cars in the next 5 years as they thought. But we still have a number of residents who will pay the $350 for us to cut the hole in the garage, put the charger in there, and then we charge them $5 a month or something like that. But again, it's other income that helps our yield and gives the resident, a charger in the garage.
Yeah, Richard, what is the balance? What does it look like as far as expenses go? I mean, this is all separately metered for utilities, separately metered for water. What expenses does a build to rent community have?
Well, the 2 biggest are what we call uncontrollables, right? Property taxes.
Would be Jake too. I can't control Jake, so that's another expense as well. Okay.
Wow, man.
Yeah. And insurance, right? Those are the 2 big, what we call uncontrollables. Insurance has been crazy, you guys know, in Florida. Mm-hmm. But anything coastal is prohibitive, which means your margin, right? Your profit margin, if you will, is constrained. That and property taxes. The rest is pretty easily predictable. I would say the other big part is payroll, right? The people that are the guys who are changing the AC filters or learning how to install the tech package. our leasing folks, right?
He's
Our
had to steal
sales.
people from Google now to take care of these Ring cameras and things, Gino. That's what he's saying.
Yeah.
Yeah, but Google people, they go to sleep for half the day and they have their little nest and they need safe spaces.
Because
So
they plug in. They're like cyborgs, right?
they're not
Right,
going to
and they
maintenance
want,
nets.
and they want stock and all of that. So, regardless, it is a conscious effort to keep our costs under control. And we talked about land; that's the biggest impediment to building more homes. I mean, depending on who you talk to, the Census Bureau says we're short 6 million homes in this country. Others are more conservative. I put the number somewhere between 3 and 4 million. That's a lot of homes shortage. So that's demand drive. That's the supply is severely constrained. And then when you can't find land, and look, land is not necessarily scarce. Obviously, the further out you go from
Yeah, but it's just less desirable. I
correct.
think
And
the
look,
correct statement is desirable land is scarce.
it is. And it's also hard to get through the entitlement process, right? The zoning and entitlement.
You got a lot of NIMBY warfare going out there.
You got NIMBY warfare. You also have municipalities who, there's always has been this stigma about a renter and, a second-class citizen. We've disproven that with statistics and with actual data. However, when you're talking to a mayor and a city council,
they're very discriminatory. They say
they
one thing and
are.
they do another. They got to stop the discrimination. Renters' rights, baby.
And unlike us, who are back in the office, we're talking, we're working, they dismissed a lot of their staff during the pandemic and they haven't brought them back. So what used to take a week to get I'm just going to make this up, you have a tree plan, right? You got to plant a certain number of trees to make the community to get it approved.
Their architectural guidelines.
Yeah, to get that plan stamped, okay, Richard's planted the trees, used to take a week. You go in, the guy's in the office, maybe you have to wait, buy him a cup of coffee, and he stamps the plan. That could take a month now because the guy's working from home or he's, not in the office or whatever. So that's a big impediment to adding to supply.
Richard, before we go to the short answers, I want to jump right back into the expenses as well. In these communities, are you cutting the grass? Are you taking care of the pool? Are there other expenses on here?
Yes, we are responsible for everything. So we hire a landscaper, right? We cut the grass, we maintain the pool, and it depends on the amenity package. That's governed by the sort of size of the community. The larger the community, the more amenity rich it is. We can talk about that. So yes, we're maintaining the grass, and typically that's a third party landscaper. We like to use local folks because we think they do a better job. We're maintaining the pool. We're maintaining the clubhouse. We're changing the HVAC filter in every home quarterly. That's
kind of tagging in with pest control.
Yeah. We do pest control. The reason I mentioned the AIC filter is it gets us in the home. So we get one of our guys in the home to kind of see what's happening in that home.
They're playing Mission Impossible music when they're doing it.
Well, not that we're trying to spy on them, but we want to see, does this person have 8 dogs in there, tearing up the flooring or do they have more people in living in the home than is on the lease, that kind of thing. It's just a
quality control, quality check.
Exactly.
All right, guys, let's take a quick time out here from our sponsor.
This episode of the Jake and Gino Podcast is brought to you by Wheelbarrow Profits, the premier multifamily education community. Wheelbarrow Profits proof is in their results. Their members have closed over 86,000 units. That's over $5 billion in student deal volume. Are you serious about taking your real estate game to the next level? Do you have the confidence to take action? Schedule a call with the Wheelbarrow Profits team today and supercharge your real estate knowledge. Build lasting relationships through unparalleled networking opportunities. Obtain lasting knowledge on how to buy multifamily real estate with intensive training. Gain hands-on experience through their live events with like-minded individuals and industry professionals, all while experiencing the personal touch and family atmosphere that set them apart. Visit wheelbarrowprofits.com for more information.
All right, we are back. So let's talk about the evolution of debt in the build to rent space, because you're speaking to folks early on and they said, "You smell, Richard. We don't want anything to do with you, crazy man." And now you're probably cozying up and getting cuddly with Fannie Mae now. Is that right?
Well, yes. Our Fannie, the agencies that we call them, right? Fannie and Freddie are now financing build to rent deals. They're also looking to put together a more comprehensive, larger facility. They've done a number of sort of one-off.
What do you mean by that?
Well, you build a typically what an agency would do. You guys know this probably from your multifamily background. You'll build a $50 million community and go to Fannie, and they'll give you a 65% loan to your value, and that's what we call a one-off individual loan. They're now talking about building a facility where you can put 20 communities on this Fannie agency debt facility.
Cross collateralized?
Yes, typically they want them cross collateralized. Well, yes, but if you're a long-term owner and you get, that's just a math exercise, Jake. Is the reduction in rent and the increase in loan proceeds offset the perils?
No, I'm sure it's a great fee experiment, but I just like to keep everything siloed at times too.
The evolution of our debt structure has been, as I said, at first they were like, "You're going to do what?" These are banks. We did find a regional bank in Texas.
That's where it started.
This is in August of 20, so middle of the pandemic.
Dude, it's so weird. Like I feel like this has been going on longer, but it is new. Like 5 years, it's crazy.
Yeah, I mean it really got its legs 5 years ago.
Yeah.
And so we found a regional bank that was willing to finance one individual communities for us. And then we graduated to one of the big New York banks that did what they call a warehouse.
Community Bank in New York or whatever?
No, not that. Then now we have a
well, they did a lot of stuff. So
we have a credit facility that's $1 billion, and it's funded by 7 different banks, big banks you would know, and it allows us to buy land. That's one bucket. To finance construction, that's a second bucket. To finance completed homes, right? That's a third bucket. And then a stabilized community. So there's 4 different buckets and leverage points, to your point. But that's only been in the last 2 years, meaning that this business has started to become attractive to large lenders. And the agencies have been, and now even the life insurance companies are getting into the financing these communities.
So obviously you're in this space now. Do you feel like you are in like the premier spot in real estate right now? You feel like, man, I'm not diversifying from this. I'm just going to continue to go in, or do you think there's any risks in where you're at right now?
Well, you never want to put. I'm talking personally now. You never obviously want to put all your eggs in one basket. I will say this is an industry. I mean, I came up in the multifamily industry in the early '90s, as I said earlier. We're not even in the first inning. Mm-hmm. We're in batting practice. This thing, and over the next 30 years, build to rent is somewhere around 2% of the multifamily stock in this country. Multifamily is somewhere around a third.
You think it has legs?
I think it has legs and long legs, right?
What part of what percentage of the market share do you see this thing going to?
So there's roughly a third of the housing in this country is rental. Mm-hmm. And as I said, the build to rent is 3%.
2%, 3%.
Yeah, I don't know why it couldn't be half of the rental stock. Just because of the aging of the population. I mean, yes, we have aging millennials in our homes, 38, but we have a lot of people over 50 empty nesters as residents in our communities for all the reasons we mentioned. Maintenance-free lifestyle, flexibility. They want to be near the grandkids. They don't want to live with the grandkids, but they want to be near them. So there's a lot of drivers to the longevity of this business.
I saw a BTR the other day, and all white. The vinyl did not look super attractive, wasn't the best design. And I was just thinking to myself, and this goes back to what we were talking about with the cost before, but a little bit of brick on the front, a little bit more care into the design, and you step back and go, holy shit, we got a beautiful community here. And I'm thinking to myself, am I missing something? And I'm talking to the guy right now. So what would you have done in that scenario? Because I'm looking at it and going, yes, costs matter. I'm very cost conscious in our business. But you could have made it just a little bit more, aesthetic. And you sit back and there's pride of ownership. People are going to want to live there more. I have to believe. Or am I missing something?
No, you're absolutely right. And we are intentional in the design of our communities, meaning it's not a row of the same facade, right? We bump them in and out, right? We do a little brick, a little stone, We typically don't like vinyl siding. We like hardy board. Not to give anybody a plug. And then
No, but that's great feedback. Don't hold back, because I think that
we put a tree in every yard. That's kind of one of my things. The aesthetics do matter.
What tree do you prefer?
Well, it depends, obviously, right?
Are you doing like evergreen, or are you doing something that's
these are usually hardwoods, right? Because they're easier to maintain and more hardy, if you will. The amenity needs to be open when the community is starting leasing, and the amenity needs to be at the front, not at the back. A lot of home builders, right, when you go into a Pulte or a Lennar or one of their subdivisions,
drive into it to find the clubhouse.
Yeah,
and wonder where the hell this
it's
thing
typically
is.
the last thing they do, because it's kind of an afterthought. We're very intentional in that amenity.
Well, and also I think they're doing it to offset costs, right? They want some revenue coming in before they're putting into it, probably, right?
Right.
Yeah.
So, exactly right.
So today you have this group of banks that you're financing the build with, and then you're sending it out to pasture to Fannie, probably. That's what's going on.
That's the business plan, yes. And then we'll own this thing for as long as we can.
And so I was kind of going through this earlier. From a raw land perspective, what do you think on average in the Southeast things are trading at right now? You think it's like mid-20s? You think that's sort of the mark, or what do you think? What do you think things are?
That's probably low.
So you think higher?
Yeah. I mean,
mid-30s.
And in Florida, I mean, it's crazy. You guys know, and our focus when we look at a community, evaluate a community, it's jobs, employment. How far are we from the employment?
Be next to the Amazon plant. Yeah.
100%. Second is proximity to retail. Can they go grocery shopping? Can they get their nails done? Can they go to the doctor? Right. It used to be schools were.
When's the nail salon coming into the build to rent mixed use version of your communities?
Well, we actually
Starbucks, little mochaccino.
Don't laugh. We probably have 4 or 5 communities where we're part of a mixed use, and then we sit very well. You can walk to the grocery store, right?
Yeah.
That's a huge draw. And I say that schools used to be sort of the second criteria, and then retail was third. We've kind of reversed that because a lot of our residents, at 34,
that's a beautiful
don't
thing,
have
man.
kids.
Hey, can we walk to the pub? Right? Can we walk?
Exactly.
Yeah.
So
I like that.
We've learned that that's a huge amenity, if you will, to be able to walk to Publix, using the Florida analogy. Right?
Well, and here's the thing: you want to go to Publix because they're going to bag your groceries and treat you nice. Okay. Used to be a Kroger guy. Kroger, you're losing me. I'm just telling you, you're losing me. Okay. Publix is pulling me in because it's about service.
And that's why they're expanding, all over the South. I mean, they're up in
just like Richard's communities here. Hey,
and look, I will tell you guys just straight out, when we look at a neighborhood to build a community, we see where the grocery is, Publix is, and where the Target is,
and
right?
where the Chick-fil-A is at. Come on,
there you go.
Give me some of that. Yes. Gino, get yourself together and bring us home here.
Okay, this is it's been a great story because Richard started back out in the 90s. He saw all the powerhouse multifamily communities. They started growing in the 90s, and over 4 decades, as Jake likes to allude to, he's gone from the multifamily guy to the cojones and having the capital, and starting back in 2019 on a vision saying, I'm going to do this build to rent. This sounds like a pretty cool thing. And when he goes into the bank, the bankers are like, Richard, what the hell is wrong with you? This is the stupidest thing
This is
I've
real
ever
estate.
heard in
We
my
don't
life.
do that.
There's no way this is going to work. And 5 years later, he's like, well, I proved them wrong because I've got 5,200 units and I'm continue to buy these things and build these things. So you put a little cojones, you mix it up with a little capital, and you look back and you're like, 5 years later, I got 5,200 units. So congratulations on the business plan and for actually taking the risk. Because like I said, I saw this 8 or 9 years ago and I thought this was crazy as well. I couldn't get my mind wrapped around it. And I think to speak and to mention the last thing is there's a lot left in this build to rent. It's not just a fad that just started. It's got a lot of legs. And if you're getting into the space, you need to have a little experience and surround yourselves with guys like Richard.
Well, thanks, guys. And I'll just say, yes, there's a lot of opportunity here. It's not for the faint of heart. So, Gino, next time you come across something in real estate or whatever, and you say, what? Should I do that? Do it.
Just do it, Gino. Well said. Gang, as always, we believe in buying deals for the long term. Think in decades. I'm Jake. He is the G Daddy. We make it happen. We'll see you next time.
Thanks, Richard.
Thanks, guys.